Hey traders, welcome to the channel, The Novel Trading. I'm your trader and trainer, Mr. Goel over here. So in today's video, we are going to reveal the name of the prize winner of our previous giveaway challenge. In the previous video uploaded, I have told you about the technical analysis and the trading profits. In this same video, as I told you that there will be a giveaway challenge as well. The question for the giveaway challenge was, what is slippage and how can we stop it? What is one measure to avoid the slippage in the market? So in today's video, we are going to understand a very important concept about the slippage in trading. Now, this is the cost of trading. You have to understand, guys, there are many aspects of trading or many concepts of trading that we try to learn and earn over here. But the slippage concept is not related to your technical analysis or not related to your fundamental analysis. The slippage is mainly related to the cost of doing business. Yes, guys. So we are going to understand what is slippage in the market and how can we avoid it. Okay. So what I'm going to do, I'm going to share the whiteboard and I'm going to share some pointers with you so that you can understand what exactly is slippage and exactly what are the methods that I use myself to avoid that slippage and to reduce the cost of doing that business. See, when we are having some profits, let's say if I earn 50,000 in a single trade, my whole 50,000 is not going to be the profit. If I have put up a target, taking some price example, let's say I bought some shares for Microsoft and I had a target for 50,000. But if you will understand, once the price reaches to your target, the whole profit or the target which you're looking at 50,000 is not your whole profit. There is cost of doing business in this field as well. First cost is related to your spreads and the commission that you pay to the brokers, right? So spreads and commissions are also one of the major thing that increases the cost of doing business. When we start the trading business, we try to approach to the brokers or we try to negotiate with the brokers or try to find the perfect broker which has zero commissions or which has zero spreads in the market or the lowest commissions or the lowest spread in the markets. So one such broker, I have put up the link in the description as well. If you're trading in Forex markets or you're trading in currency or you're trading in US stocks, you can open your trade account via the same link as well. Okay, guys. So now if you're talking about slippage is one of the very important thing or also the very important cost of business. And our whole objective with the aspect of slippage is to reduce it as much as possible. Because if the slippage increases with your orders, or if your orders, let's say, are having much more slippage cost, then you will see that your realizable profits will be less than your targeted profits. So now let's talk about the slippage over here. First, we will understand the concept and then we are going to go on the real charts to make sure that you have the practical aspects of it as well. Okay. So basically, if you're talking about slippage, as I told you, it's the cost of doing business. The aspect that we are talking about is the cost. And what do we have to do with the cost? We always try to aim to reduce the cost as much as possible. You cannot eliminate the cost. First, you have to very much understand that there is no such way where you can eliminate this cost. So our whole criteria or our whole aim with the regard or with the aspect of the slippage is to reduce it as much as possible. Okay. When does slippage happens? Majorly you have to understand. Basically, it is the difference in price of execution at the order punch. Let's say I want to buy Microsoft at $200.31.31. Okay, so this is my buy price and I have put up my order or I have punched my order with this price only. Now what will happen over here is once the order will get executed, once the real price comes to your order, it is not possible or it is not quite sure that you will receive your order exactly at 231.31. Sometimes it also happens that you might have bought at this price, but real trade is actually executed on 232 and there is a slippage of this. Now this is not related to spread. There is a buy and sell. So many traders who have commented via giveaway challenge, I'll show you the comments as well. They have misconceptions about the spread and the slippage. They think that the slippage and the price is the difference between the ask and the buy price. But that is not true, guys. The spread is already there. Okay. So when we are looking at the spread, it is already there. But when we have punched the price, obviously we are looking at the price which we want to buy at. Now, if the price comes over here and it is not executed at 31 and rather it is executed at 32, that means this is the slippage that you have got over here in the market. Okay. And this is the cost of doing business. What most of the time happens is mainly you will see that whenever you have punched a stop loss or you will have put a stop loss below your buy order or above your sell order, you will see the order or the stop loss order is not executed at the same price. Okay. It is having a little bit far or it is having a little bit more difference. So let me share the charts and show you the practical division. So on this chart, we are going to take a practical example of how the slippage really happens. And within the same chart, I will tell you exactly how to reduce the cost of the slippage. So let's say, for example, in this market, I have put up a buy order over here, somewhere over here. I have put the stop loss on the low of this candle and I've tried to target towards the upside. Okay. So this is one practical example that I'm talking about. This is a pure hypothetical example that is over here. So what happens over here is the price started going in your direction, taken a buy, the price has started going in your direction, but it has not touched your target over here. And what did happen? Rather, the price tried to reverse against your position. Okay. So now what will happen is most of the times you will see that if you have put up a limit order over here, exactly. Okay. The stop loss limit order is over here at 54,850 example. Now what will happen is the price suddenly spikes downside. Okay, so it suddenly spikes downside because of the huge volatility. Okay, and what will happen is, let's say in this position I have made a stop loss of $100. Now what will happen is, once the price will hit the stop loss, once you will go to the PNL after the close positions, your PNL or the positions will show you, let's say minus 105. So this $5 extra put up a stop loss of $100, but actual position is closed at 105. So what is this $5 difference is? It is not spread, guys. It is the basic difference of the execution price and the actual triggered price. Okay, so this is 105 is the price with slippage. So this $5 cost is the additional slippage that you have to bear from your profits or from your trading profits as well in order to set against the cost. So this is additional cost that you have to pay. And now most of the times, why does slippage actually happens is because of the huge volatility. Now you will see most of the times this is happening once the news candles are there. So I'll show you the example of the gold. Yeah, so look at this. In this gold example, you will see much better over here. So let's say the people who have sold over here or somewhere over here and put up a stop loss over here. So what did happen in this market is, okay, we are taking a hypothetical example. Let's say there is a news going on or there's a huge candle formation that has been made over here. So your stop loss will not be triggered at this price and your stop loss will actually be triggered at this level. So this is the major difference. What happens when there are huge volatile times or whenever there is a news. Okay, so I have put up an economic calendar over here as well. If you will go and you will check out the news as well. So these are the major important news that comes out in the market. There is an important news that is going on. Let's say this week there is an important news about the Canadian dollar and other things. You will see that in these times the slippage is the highest. The variation between your stop losses and the actual prices going to be triggered will be the highest, and that is why we have to bear this cost, guys. Nobody or no trainer discuss about these things as well. Everybody wants to teach you technicals, everybody wants to teach you fundamentals, but not all the trainers or the traders are trying to talk about the practical aspects of the trading, that these are also the additional costs. And because you're not aware of such costs and because you're not aware of such things that are going to happen in the market, you are going to get emotional. You're going to get disrupted in your mind because your position was somewhere and you had an additional stop loss because of that. So these are the things that you have to keep in your brain while doing the business of the trading, that these are the costs that you will have to account in your PNL, that you will have to account in the books, and then draw the net PNL. Net PNL is not just profit minus stop losses. It is about profit minus stop losses, minus spreads, minus commission to the brokers, minus slippages and other things as well. Okay, so we are going to discuss a lot of other things in the detail as well in the coming videos. So do not forget to subscribe to the channel, guys. Now we are going to come to the aspect where we are going to understand how can I reduce the slippage, because all the time you will see that there are huge slippages that are going to be there. So we are going to discuss some steps which are very important that will actually reduce the cost of slippage over here. So first of all, and very important step is, guys, you never have to trade on the news time. If you are going to trade on news timing, just prepare yourself that there will be slippages. 100% there will be slippages in the market. So if I'll share the board again, so as I told you, there will be times when the slippages will be there. So what are these times and you have to avoid? These are, first of all, is news timings. Okay, whenever there are news timings in the market or whenever there is going to be important economic news or the fundamental news that is going to be declared, let's say example FOMC data or example the CPI data, let it be PPI data, let it be GDP data, exactly on these news timings 100% slippages will be there. So you can avoid these timings because there is high volatility while these timings are there. So you need to avoid the very high volatile periods to avoid the slippages or to avoid your account being blown up because of these slippages in the market. So next is very important. You have to avoid market orders. Now this is one thing that many people might not have told you. Market orders contain slippages. They are 100% made of slippages only. Now why there is slippage? You have to understand this very importantly. There is always a chance that whatever data you are looking at while the candle is being formed, this data, while this feed is being shown to you on your trading or your charting platform, it is delayed by milliseconds, by some seconds. Even if you have the highest or the fastest internet in the world, there will be some milliseconds difference in the data that is being shown to you and that real data that is actually being there. So whenever you put a market order, let's say there is a price going on something like this, and I want to sell. Let's say my criteria for selling is the candle, if the low of this candle breaks, I will take a sell. Now what will happen is, you have to understand, you are preparing yourself to sell at this level, let's say $100. Okay, you are preparing yourself to sell at exactly at this level, and what will happen is, as soon as you would see any candle breaking out this major low of the candle, it can be trend line, guys, it can be support as well, anything, but I'm just telling you about the price levels. Now you saw in this moment, as soon as the candle break this major thing or break this major pivot level where you are preparing yourself to sell, and you're going to put up a market order for the sell. sell, right? Now, there's the point. This is not the exact feed. This is a delayed feed. What will happen most of the times, you might have also experienced this, is that in the next second itself, the next candle gapped up and your sell order exactly happened over here. That is at 105, or let's say 102, or let's say 101, or anything, right? This is majorly because when you're putting market orders over here, the feed price and the execution price always have a difference. The candle is being formed by the softwares, the price is getting tabular, or let's say it is getting graphically formatted in front of you. The software will take the time, the charting software will take the time, the internet takes the time, but the data, when it is come to you in front of your eyes, even your brain, when processes this information and sees the breakout or the breakthrough, it is going to take the time. And this time, whether in milliseconds or let's say microseconds, it is going to hamper or it is going to give you some slippage. So market orders are made up of slippage. Okay, you have to understand that if you want to avoid slippage, market orders you cannot put either selling or either buying. There will be slippages. And very, very important, last but not the least, to avoid slippages, I'll tell you this measure on the charts itself so that you can understand properly. Okay, here's the chart and try to understand the example. The most of the time, slippages will happen when you're putting the stop losses on the major highs or major lows. Okay, somewhere over here or over here, let's say even over here. And this is the most liquid areas in the market. That's where the most liquidity is there. And you have to understand that these are the pivots where the most slippages happen. So let's say if I put up a sell order over here and I'm going to put my stop loss over here, and the price is going through and I've not realized the target, the price is going through. What will happen if you will look at this green candle is not at all is going to give me the exact stop loss. It is going to become with a very high speed or very volatility because a lot of liquidity is clutched over here. These areas, okay, these major highs and lows, you have to understand these are the major points where the slippages. So if you want to avoid the slippages, let's say if you're buying from this position over here and I'm putting the stop loss over here, I expected that the price will go up and it did. But what did happen? The price first took out my stop loss. So over here, we say stop loss hunting has come and other concepts are going to come, but not just that. You have to understand, yes, this is a point where the stop loss hunting is here. Yes, this is a liquidity hunting area, but what most you have to understand is this is the highest point where the slippage is going to happen, because this candle, while being formed, is not just going to be very easily or slowly it is going to be formed. This is why it'll be like this. And this is where you find most of the slippages. This is where you find that the stop losses are not matching with the positions that you're closing with. Let's say if I put up a stop loss of $1,000, but your closing PNL is saying minus 1008, or let's say minus 1010, something like that. Now these $8, $10 that you're going to give is the slippage cost. So never ever, or just try to avoid these kind of stop losses, because this is where the major manipulations happen. So rather than just putting the exact stop loss on the low of this candle, let's say it is 337.249, make it a little bit less, and just to avoid much more, make it a little bit higher. Because if the price wants to go below, as soon as the price will go below this level, this is not going to stop. Price will actually match your orders over here and not over here. So always put your stop loss orders, or always put your even entry orders a little bit higher or a little bit lower to the exact high or low. Okay, guys. So this is one of the major things that you have to take care while doing this. Slippage is one of the costs. Okay, I'll just tell you my personal experience. I have made around $2,000 to $3,000 given, give or take, like 100 or plus minus in slippages zone. Okay, I'm just talking about this year, not previous years. So the slippage cost that I have booked till now, from like January till end of the May, like June, it's around $1,000 to $2,000 just with the slippages cost. So try to understand the magnitude of the cost that you're paying while taking the trades, or while putting the stop losses, while taking the market orders, while doing this and this. And this is when I'm talking to you, when I've tried to take a lot of measures to reduce this cost. This is something that you have to take care while you're trading as a regular business. This is when you are doing consistent trading and trying to approach with a higher capital. Slippages might not catch your attention when you're trading with very small capital. Let's say you're taking a $10 stop loss or $100 stop loss, then $1 to $2 slippage might not affect. But when you're taking a $1,000 stop loss, when you're taking a $10,000 stop loss, and you're giving extra hundreds, okay, when you're giving extra tens, just with the slippages, and that matters, because every orders is going to contribute to your losses. This is not something that you're gaining. This is the cost of doing business. So these are the measures that you have to take when you're trading on high capital. Even if you're not trading on high capital, even if you're at a beginner level or you're taking care of some capital, you need to take care of such things as well, because these are the practical aspects of trading that nobody's talking about. And I don't know why, but these are the things which is actually hampering your P&L year on year, monthly on monthly, and weekly on weekly. So slippages in an order or a single order or two might not affect you. But when you're taking, let's say you have a package of 500 trades in a whole year, and let's say out of these 500, at least 300 orders will come with a slippage. So try to understand the magnitude of this concept. And 360% of the trades even try to catch a P&L. Okay, just look at your P&L. You will see that there are so much slippages in the account, and these slippages are the cost of doing business, and you have to downsize the magnitude of this cost. Okay, guys, so this is the major concept which we have talked over here. Now let's read some comments and let's see who has understood or who has won the prize. So let's go to the channel. Okay, so I've opened up the video from where we are going to read some comments, the people who have commented for the giveaway challenge, and we're going to understand who has given us the best answer. So first was, it is a high volatility gap up and order slippage. So this is a really unclear answer. Okay, slippage mostly gap up and gap down. Yes, but there is no measure. I have told you that you have to write down one measure for avoiding the slippage, guys, as well. A typical example of the slippage in stock trading would be if the Microsoft has a bid-ask spread of 109 and 10.9.25. So this is, as I told you, this is a spread. This is not slippages. Slippages is when, as I told you in the whole video, you can just go through the video again to understand the slippage. So another comment was, the slippage is when the price is at which your order is executed does not match the price which was it requested. So this is a good answer. If you will look over here, this is executed and the requested price is not matching. This most generally happens in fast moving and high volatile markets, which are quite susceptible to the quick and unexpected turns in the specific trend. That's good, but you have to also write one measure to avoid the slippage and to win the price. It's basically high volatile momentum in the market, like gap up or gap down. Very good. Don't trade in high volatility. This is a good answer, as one of the measures is this only. Okay, so I have also replied to the comments as well. I cannot read them all, guys, but I'm just reading out the most important ones. Otherwise, if you can see, I've already replied to the people who have commented on this video. Price एकदम से ऊपर नीचे चला जाता है, जहाँ किसी और का ऑर्डर लगा होता है वहाँ स्लिपेज हो जाती है. Yes, so the answer is in Hindi, but mostly it is right. News trading के टाइम सबसे ज्यादा होता है, so news trading has most slippages. Limit orders लगाएं, that's good. News trading avoid करें, that's actually good. Okay, so this is one of the good answers. Okay, so many other people have given very nice answers, guys, and if you are just moving on, we'll see this answer as well. Avoid volatility, that's good. Avoid trading during the high times of the volatility, that increases the chance of the slippage. Use limit orders, as we discussed in the video as well. Do not use market orders. Limit orders is best. With the limit order, you can set the order to be executed at a certain place. Trading in instruments with liquidity, that's actually another good measure. Okay, and avoid volatility. Avoid high trading times of high volatility and increases the chances of slippage. So these are the very good answers that we have learned through, and this is one of the best answers that I can see over here, because the measures that we have discussed in the video and the measures that the person has wrote matches a lot. So this person has written a good answer over here. The answer actually matches measures that we have discussed in the video as well. So I declare this person as the prize winner. This person can actually claim the prize on a WhatsApp number. You can WhatsApp us on 9999494844 with the giveaway challenge. So as I told you, there will be a giveaway challenge in every video, guys, and the next video is going to be uploaded very soon, which will have the next giveaway challenge, guys. So we discussed a very good concept today regarding the slippages. If you have any questions regarding the slippages, you can ask same in the comment section, guys. And if you need any other help while trading in the markets, while trading with real monies, and you're hassling with your psychology or your technical concepts, you're most welcome to greet and ask your questions. Till then, hasta la vista. Do not forget to subscribe and like, guys. And if you have any questions, feel free to contact.